A top story this hour, UK retail sales volumes rose by 0.9% in January after a fall in December 2019. This was the biggest rise since March and a stronger turnaround than the 0.7% month-on-month growth predicted on average by economists in a Reuters poll. The bounce back was even more marked since fuel sales are excluded, with sales up to 1.6% on the month, the biggest increase since May 2018, and above all forecasts in the Reuters poll. Arise business correspondent Laurie Laird reflects on the latest figures. Okay, so does this bode well for the UK consumer? Does this mean that they're, alive and kicking?
It certainly means that there are life signs for the UK consumer. As I mentioned, there was really the UK consumer was looking very, very unwell toward the end of last year, and that was exacerbated by a very small rise in household spending in Q4 GDP. Household spending only rose by 0.1% over the earlier part of 2019. We had got used to seeing rises of 0.4%, 0.5%. When the consumer really slows down in the UK economy, there's not a whole lot else right now that can take up the slack. Business investment has been very, very weak since the referendum to leave the European Union in June of 2016. In fact, we've only seen 1 quarter of growth in business investment since that referendum. So it really has been consumer spending that's doing the heavy lifting in the economy. So it was, even more worrisome at the end of last year, where the consumer looked on his or her knees. So there will be a great deal of relief that consumer spending is ticking up a little bit, but it's a volatile series, this retail sales number, Rhoda. So it's 1 month. 1 month does not a trend make.
All right. So how closely will the Bank of England be watching these figures?
Well, we know the Bank of England does keep an eye on these data, despite the fact that for any 1 month, these data can be incredibly volatile. There's an element of seasonality in these data. So certain sales at Easter time or in the end of the post-Christmas sales, sometimes there's a seasonal factor that the economists cannot really account for. So despite the fact that there's some variability in these numbers, Bank of England does watch them quite carefully. This is the third encouraging set of data that the Bank of England will be going through that was released this week. We had a very strong jobs growth on Tuesday. The economy created 180,000 new jobs, which shows that the economy is in reasonably good shape. Although wages are not rising all that quickly, it suggests that that job creation was sort of at the lower end of the pay scale. Nonetheless, unemployment remains very, very low at under 40%. That's the lowest level in more than 40 years. We also saw an uptick in inflation yesterday. Inflation, which had been running at an annual rate of 1.3%, which is well below the Bank of England's target. That ticked back up to 1.6%. So the Bank of England will be relieved that that inflation is coming closer to its 2% target. And I think all of these data taken together will prevent, I say, the Bank of England from moving on rates as early as next month. There has been some debate about whether the Bank of England may be forced into a rate cut, particularly after we saw that very weak fourth quarter GDP data, no growth at all in the fourth quarter. There have been 2 members of the bank's Monetary Policy Committee that have voted for an immediate rate cut over the past 3 meetings. They were overruled by 7 other members of the MPC. But I think because this week's data are looking a lot more healthy, a lot more robust than what we saw at the end of 2019, that the Bank of England will probably stay pat when they meet next month. Although coronavirus is a big unknown in not only the Bank of England's forecasting, but central banks across the world.
Interesting stuff. So how are the markets reacting to this news?
The markets barely noticed it, Rhoda. The third week of the month in the UK is when we get a deluge of economic data, and usually investors are geared up to assess this data to try and figure out whether it means a rate cut or a rate hike was ever more or less likely. But there's been very, very little reaction to these retail sales data, and often they are market movers because, as I mentioned, they can be quite volatile. I think that investors, after seeing that strong jobs growth, after seeing that uptick in inflation, had already made the decision that a rate cut is probably not happening in the UK anytime soon. So I think that's why we saw a muted reaction in response to these data. FTSE's down a couple of points, but they're basically unchanged on the day. Sterling has barely moved at all, but we did have a bit of an uptick earlier this week as traders digested the sort of a delay in an interest rate cut. But we are seeing a little bit more dramatic movement in share prices in Europe. German shares are down about 1/3 of a percentage point. And European investors are thinking a little bit more about coronavirus. The line on coronavirus so far has been, doesn't look like it's going to be that bad. And if it is that bad, if coronavirus does cut into industrial production in China and in further afield, it will be there will be what the economists call a V-shaped recovery. So output will go down in a hurry at a very accelerated rate. When those factory lines come back up, we'll see a recovery, the other half of the V. So that has been the story that economists and investors have been convincing themselves. But we saw two companies in particular in Europe come out with really quite grim outlooks because of coronavirus. One is Maersk, the big Danish shipping company, in fact, the biggest shipping company in the world. Maersk operates 1 in 6 container ships. They said February and March, their business essentially came to a standstill. They're looking for a very weak second quarter. Accor, the French hotel chain, said something very similar. They depend on China and Asia for a lot of their revenues. So the potential longer-term effects of coronavirus on business are on the minds of European investors today.
Oh, wow. And so with regards to the muted reaction from the UK market, what about the US? What sort of open do you think we're going to see, if any, reaction to the UK retail numbers?
Futures markets are pointing to a basically unchanged open in the U.S., but I think the crucial point with the U.S. is that even if the markets open unchanged, they're still opening at very close to record highs. The S&P 500 hit another record high yesterday, as did the NASDAQ Composite Index. Dow Jones is only a couple of points below record highs, and you think this is happening at a time where the U.S. economy is in a slow growth phase. It's not in recession, nowhere near it, but 2% growth in the U.S. economy is reasonably sluggish. It's just below trend growth. But we have so many uncertainties about coronavirus, yet investors have been able to shrug this off. Every time they look at a new list of infections, death tolls from China, they're able to say, they're convinced themselves of that V-shaped recovery that we just mentioned. I kind of wonder, though, whether they may be a little bit overly optimistic. Rhodas, you've heard the term a black swan event. It's a term that entrepreneurs and investors use for an unpredictable event, but one that could have potentially catastrophic consequences. To me, coronavirus is a black swan event, and I think the risk of a pullback in U.S. share prices exists. Goldman Sachs came out with a report today. They are predicting a correction in U.S. share prices. A correction is defined as a 10% retreat from a peak to a trough. So Goldman Sachs is saying, wait a second, things look a little overvalued. You've got to wonder whether other investors are going to start to think the same.
Now, with regards to, I want to take you back to the UK retail numbers. Fuel sales, can you talk a little bit about whether or not, what direction that moved in as far as fuel sales were concerned?
The fuel sales is really interesting, and when you take that, because fuel sales to a certain extent, we think of them as a non-discretionary item, right? If you have to fill your car with fuel, regardless of the price of fuel, you do have to go and buy it. But fuel prices were up more than 4% between December and January. That's a pretty hefty rise, and that came after crude oil prices rallied quite dramatically at the end of last year. It turns out that price the demand for fuel can be somewhat elastic. When the price rises, people do buy less of it, and that's what really dampened retail sales as a whole in the month of January. However, crude oil prices have begun to fall. In fact, they've fallen quite dramatically, partially because of coronavirus, partially because investors think that China is going to need a lot less energy while factory lines are closed. So we should see a retreat in fuel prices in the months to come.
Thank you so much, Laurie Laird over there in our London studios, giving us all the information on the UK retail numbers, which are quite encouraging.